Welcome back to Reg Talk UK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation.
And for this deep dive, we are looking at some pretty fundamental questions about trust in the UK financial system and just how fragile it might be.
Absolutely. This week throws up some really uncomfortable questions about value and, what we trust. On one hand, you have the Bank of England quietly admitting there's a potential 250 billion stablecoin deposit risk.
And at the exact same time, you see Coinbase launching FSCS-protected savings accounts. So they're wrapping themselves in the very safety net of the incumbents.
Exactly. And then, away from finance, you have a single cyber attack on Jaguar Land Rover that was so severe it actually caused the national GDP to contract by 0.1%.
Incredible.
So our mission today is this. When these established institutions start showing such clear cracks, what are regulators and policymakers really trying to protect?
I think we have to start with that staggering figure, that 250 billion. It all comes from the Bank of England's latest consultation on systemic stablecoins.
Right. And what's really interesting here is how much their stance has softened after the industry pushed back.
It's a huge shift. They were initially looking at very strict 100% reserve requirement.
And now?
Now, systemic stablecoin issuers can hold up to 60% of their backing assets in short-term UK government debt. Gilts.
So a major compromise, but they still need to hold at least 40% as unremunerated deposits at the Bank of England itself.
It's a clear policy trade-off, definitely. But the real story, I think, is in the holding limits they're imposing.
Okay, what are they?
£20,000 for individuals, $10 million for businesses. And you have to ask why those numbers. They feel almost arbitrary.
You'd think they'd peg it to the FSCS limit, the 85,000 pound mark, if it was purely about stability.
Exactly. And that's where the bank's own modeling is so revealing. They actually ran the numbers on what would happen without those limits.
In a severe stress scenario?
In a hypothetical severe stress scenario, yes. The additional demand for central bank lending could rise to an absolutely eye-watering 250 billion.
250 billion. So the central bank has just put a price tag on the competitive threat.
That's precisely what it is. They're quantifying the risk of what they call disintermediation, a rapid flight from commercial bank deposits into what's seen as a safer, cash-like digital asset.
So the limit isn't just about stability, it's about protecting the traditional banking model.
It's an explicit mechanism to stop banks losing their cheapest source of funding, their deposit base, practically overnight.
The moment the central bank has to actively defend the incumbent funding model, the game has changed, which is the perfect segue to Coinbase.
I mean, their move this week was strategically brilliant. They've just wrapped themselves completely in the existing regulatory armor.
So this new account, it's a GBP cash savings account offering. What is it?
3.75% AER. Variable, of course, but with instant access, no minimum balance.
And the killer detail, of course, is that it's FSCS protected, up to £85,000.
Yes, through their partnership with Clearbank. And it's crucial to note, this only covers the fiat GBP cash, not your crypto holdings.
Of course. But what for banking professionals is huge, isn't it? The whole unique selling point of a high street bank, their safety premium, it's just been commoditized.
Completely. Coinbase now has identical government protection, but with better rates and more flexibility.
So if you're a high street bank, you have to immediately ask, what is our value proposition now? When a crypto platform can beat us on our own turf of safety and trust?
It forces a very difficult conversation about the value of a physical network versus the digital rates they can afford to pay.
And speaking of systemic shocks, let's step away from the digital for a moment and look at physical disruption. That Jaguar Land Rover cyber incident.
It's not just an operational resilience issue anymore, is it? It's a macroeconomic event.
Absolutely. I mean, we've seen big cyber attacks before, but one that actually moves the national economic indicators.
The numbers are stark. UK car production just collapsed. It fell by nearly 29% in September because of one incident.
Then the ONS, the Office for National Statistics, explicitly noted that this single event caused the entire UK economy to contract by 0.1% that month. They said without it, the economy would have grown by 0.1%.
So a single digital failure wiped out growth for the entire country. That fundamentally redefines what systemic risk means.
Has it triggered a proper response?
It seems so. There's a new cybersecurity and resilience bill on the way. It strengthens defenses for essential services, the NHS, energy, transport.
And crucially, does it have teeth?
It does. It mandates prompt reporting, and we're finally seeing turnover-based penalties for breaches. So not just a slap on the wrist anymore.
But this vulnerability, it comes at a time when the wider economy is already looking quite fragile.
Very fragile. We saw unemployment rise to 5% in the 3 months to September. That's the highest it's been since early 2021.
And payrolled employees actually contracted in October.
And that weak growth environment really forced the government's hand. They had to execute that major U-turn on raising income tax rates ahead of the budget.
Politically, they couldn't do it. But that leaves a massive fiscal hole that has to be filled somehow.
Which is why we're hearing reports they're now eyeing things like tax relief on pension salary sacrifice schemes. It shows the sheer level of stress they're under.
If you're finding this useful, don't forget to follow Reg Talk UK on Spotify or subscribe on YouTube. It really helps us reach more compliance professionals like you.
Now let's turn to the FCA, because they are grappling with some really deep structural problems in the housing market. And they're acknowledging the system just isn't working for a whole generation.
The context here is just startling, isn't it? I saw the speech from the CEO, Nikhil Rathi.
Yes, he said that without major reform, the number of people renting in retirement could more than double by 2041.
And the financial gap is immense. He said renters might need nearly £400,000 more in savings than homeowners just to have the same standard of living.
So to tackle this, the FCA is floating some genuinely radical ideas.
Things like what?
Reevaluating part interest-only mortgages, exploring low-start lending products, even, and this is the controversial one, considering using pension savings for homeownership.
A citizen's advance on the state pension, I think was the phrase used.
That's right. Now, these aren't just minor tweaks. This is the regulator admitting the existing system needs a complete overhaul.
And at the same time, he said the mortgage charter, which was brought in for that short-term crisis,
Can now be safely retired.
that timing seems a little optimistic, doesn't it? To declare a return to normal when unemployment is rising and affordability is still a huge issue?
It does feel premature, yes.
Yeah.
Especially for lenders who are still managing quite distressed portfolios.
Meanwhile, over at the PRA, they've been busy adjusting the goalposts on capital requirements.
They have. They've raised the retail deposits threshold for the leverage ratio requirement.
It was £50 billion.
And now it's $75 billion, effective from January 2026, a 50% increase.
What's the official rationale for such a big jump?
The stated reason is to address inadvertent regulatory tightening, or prudential drag, as they call it.
Which in plain English means?
It means that because of nominal GDP growth, the original $50 billion threshold was starting to catch institutions that it was never really designed for.
Right. And they've also brought in a 3-year averaging mechanism to calculate the deposits. Why is that specific detail so important?
It's to get rid of the cliff edge effect. For a growing building society, for example, hitting that $50 billion mark meant a sudden, massive jump in capital requirements. It made planning very difficult.
So this smooths the transition.
Exactly. It gives them visibility and time to plan. It's practical, but you do have to question the consistency of just moving the goalpost by 25 billion pounds when growth gets a bit inconvenient.
There's so much more to cover. Let's run through the compliance catch-up. What are the key takeaways for professionals on the ground?
Okay, starting with economic crime. The NCA's Operation Machine Eyes 2. They seized over $10.7 million from high street businesses being used as fronts for money laundering.
So a reminder that cash-intensive businesses remain a huge vulnerability in the KYC chain.
A huge one. And on the digital side, UK authorities seized over 61,000 Bitcoin linked to a Chinese Ponzi scheme. It's a massive statement about their increasing capability to trace digital assets. The idea of crypto as a total black box is really outdated now.
What about on the consumer protection front?
The FCA came down hard on some unregulated credit builder products. They found little evidence they actually worked for most people, and 5 firms have now stopped offering them.
A real consumer duty warning shot there. The FCA wants to see tangible, verifiable results.
It is. And then there's the ongoing motor finance saga. The firms are lobbying the government to exclude millions of deals made before 2014 from that potential £11 billion compensation scheme.
They're arguing the FCA doesn't have the power to act retrospectively for that period. That's going to be a major legal battle.
A huge one. And just finally, a bit of good news for the high street. Nationwide has pledged to keep all 696 of its branches open until at least 2030.
Interesting. Why?
They're actually citing a rise in customers using in-branch cash machines, apparently for security reasons, a small show of resilience.
So this has been a deep dive into really a world of quantified risk and rapid change. We've seen the 250 billion figure for digital disintermediation,
We've seen crypto platforms wrapping themselves in FSCS protection.
a cyber attack becoming a macroeconomic event, and radical policy shifts in mortgages and capital.
And if you try and connect all these dots, it really comes down to how we measure long-term cost and value. Andrew Bailey, the Bank of England governor, gave a really interesting defense of quantitative easing recently.
That's a brave defense to make, given the huge losses we've seen from quantitative tightening.
It is. But his argument hinges on taking a total life cycle view of the policy. He argues that the early fiscal savings from QE, which lowered government borrowing costs by an estimated 50 to 125 billion pounds, should be seen as offsetting these recent headline-grabbing losses.
So he's asking us to look at the entire ledger from start to finish.
Exactly. And that forces us to accept a much longer-term, more complex accounting for central bank policy.
Which brings us to the final thought.
It raises a really important question for all of us. If we are now being forced to apply this rigorous total life cycle view to something as complex as QE, then shouldn't we apply that same long-term thinking to how we assess the systemic societal costs of other things?
Like what?
Like high street failure, like cyber vulnerability, and crucially, the long-term economic and social impact of locking an entire generation out of sustainable homeownership. Those are massive long-term costs that need to be on the national balance sheet too.
That's all from us this week. Thanks for listening to Reg Talk UK. Until next time, stay sharp and stay compliant.